If you are a trader, I'm sure this has happened to you many times. You're watching the chart, and you notice that price has already touched a certain level once, and then it comes back to that same level again. Naturally, you start thinking, this is support. Price has tested it before and bounced, so if it's back here again, it should go up once more. At that moment in your mind, it feels almost certain. Price has come back to support, so now it will rise from here. So what did you do? You bought there, because you've learned that we should buy near support. Now when you buy here, you place your stop loss just below it, which is a sell stop loss. Now what happens is, as soon as you buy, the price moves a little lower. Your stop loss is hit, and after that, the price goes up. That means what you thought, that the price would rise, actually did happen. But first, your stop loss was triggered, and because of that, you couldn't make money. This whole game is done for a liquidity sweep, or a liquidity grab. So first, let's take an example. Suppose this is a stock whose price is near its support. Whenever the price comes near support, you know the chances of price rising are high. Big institutions also know that when price comes here, the chances of it going up are high. Now look, maybe you just want to buy 100 units. That's easy for you. But a big institution wants to buy 100,000 units. But how will they buy? Everyone knows price will rise from here. So who will sell? That means for the big institution, sellers are not available. Liquidity is not available here. So how will liquidity come? It will come from you. And how will you provide it? Let's understand. When price comes here, maybe you bought 100 units, someone else bought 200 units, and someone bought 2,000 units or more. Many traders bought here. And where did all of them keep their stop losses? The rule says, you keep it just below support. So all of you kept your stop loss there. Now what is this stop loss? It's a sell stop. Because you bought, if price goes down, you will sell. So what does the big institution that wants to buy 100,000 units need? They need sellers. But here, everyone is buying. However, if price dips just below support and hits these stop losses, then all of you automatically become sellers. So what do institutions do? They push the price a little lower with their own selling. That hits everyone's stop losses. As soon as that happens, sell orders come into the market. Now the institution that wanted to buy 100,000 units gets enough liquidity. You all became sellers, and they became the buyer. They buy easily. As soon as they finish their buying, price rises from there. That means first the institutions swept the liquidity at this level. But the picture doesn't end here. What happens next? They have already hit your stop losses and made you lose money. They bought their position. Price was pushed down first, and then because of their buying, it went back up. But you missed something. When price broke support and went below, many traders thought, support is broken, now price will fall. According to the rule, once support breaks, price is likely to fall. So many traders started shorting there. That's what the institutions wanted. People selling. So many went short. Now where is their stop loss? Just above the broken support. And what kind of stop loss is that? A buy stop. So first, institutions pushed price down, triggered the stop losses of buyers, and bought. Then they pushed price up, and the stop losses of short sellers were hit too, which added even more buying. Price then went up strongly. Institutions take profit, and retail traders lose. When price reaches resistance, again, retail traders sell, expecting a fall. All their stops above resistance equals buy orders. Institutions push price up, trigger those stops, and then sell into that buying. Once again, liquidity is swept. Institutions profit. Retail traders lose. This is how institutions trap both buyers and sellers, sweep liquidity on both sides, and profit, while retail traders lose. The biggest question is, how do you know if this is a liquidity sweep or a genuine breakout? For that, there are some rules you should follow. Rule 1. Always wait for the candle to close. Most traders lose because they jump into a breakout too early. They see price break a level and quickly enter without waiting for the candle to close. If you wait until the candle closes, you'll often see that what looked like a breakout was actually fake. The candle comes back inside the level before closing. Example, you see a strong resistance. Price comes to it the third time. The breakout looks clear, but when the candle closes, it has already pulled back. The next candle again fakes a breakout, but closes back inside. That's a false breakout, a liquidity sweep. If you had waited, you wouldn't have lost. Rule 2. Study candle psychology, not just patterns. Don't just memorize candlestick patterns like hammer or engulfing. Focus on the psychology behind them. If you see multiple candles with long upper wicks at resistance, it means buyers are trying to push price up, but sellers are stronger, pulling it back down. That's selling pressure, a sign of a fake breakout. But if you see a big full green candle breaking resistance strongly, that means buyers are in control. In that case, it could be a real breakout, a liquidity run, not just a sweep. Still, trading has no exact rules. You must judge case by case. Rule 3. Check for fair value gap, FVG. This is part of smart money concepts. A fair value gap is an imbalance created when a big candle leaves a gap, compared to the candle before and after it. If a breakout happens with a clear FVG, chances are it's genuine. If there's no gap, it might be fake. Example, before breakout, mark the high of the candle before it and the low of the candle after the breakout. If there's a gap in between, that's your FVG. It means buyers were fully in control, so price is less likely to fall back immediately. Rule 4. Always check multiple time frames. If you see a breakout on the 1-hour chart, confirm it on the 4-hour and the 15-minute too. This gives more clarity. Rule 5. Use liquidation heat maps. In crypto, these heat maps show where most traders' stop losses are sitting. And guess what? Price loves to target those zones. If you see a yellow cluster, that's where the most stops are stacked. That's usually the first place price will go. Final summary, liquidity sweep is equals price hunts stop losses to create liquidity for institutions. Fake breakouts trap both buyers and sellers. Always wait for candle closes. Check wick behavior. Confirm with FVG. Use multiple time frames. And in crypto, watch liquidation heat maps. Institutions always need your stop losses to fill their orders. If you understand this, you stop being the target and start trading with the smart money. If this video helped you understand liquidity, make sure to like, share, and subscribe to the channel so you don't miss future strategies that can change the way you trade. This video is for educational purposes only. I am not a financial advisor. Trading involves risk, so please do your own research before making any decisions. TradingView.com charts have been used in this video for explanation.